All right, good afternoon and welcome to High Noon Highlights at the Pit. Um, it is June 9th, 2022. It is noon. We're seeing some interesting trade today. Let me go ahead and share my screen. All right, very good. So you all can see my screen now. Some interesting things happening today. First and foremost, let's go over what most people trade. Most people here trade SPY, SPX. Um, the options positioning still hasn't really changed all that much. If you look at the June OPEX positioning, I mean, we still have huge open interest. Um, we'll look at this open interest right here, 118,000. So nominal value, it's like 1.1 million puts right here. So I suspect if we sell off, let's say we get some bad news tomorrow, or let's say FOMC more hawkish than what people are expecting. If it breaks that 4,000, I can definitely see a little bit of a short covering. It may only last a couple of hours, but definitely for a day trade, I can see that happening. Not an easy trade. That is not going to be an easy trade. But if you guys are avid day traders and you want to take that day trade, definitely that one is out there for you if we get there. I'm not trying to, again, from yesterday, I am not trying to predict the future. I'm just trying to anticipate what could happen, okay? There's no such thing as absolutes. Nobody has a crystal ball to this. There's just a range of possibilities, and we're just anticipating 5 or 6 steps ahead, much like a chess player would, all right? Hence why we call ourselves checkmate trading. All right, so if you look at OI, I mean, we still have high OI all the way up. It's just a matter of, are those hedges going to get cashed or not? Okay, they may not get cashed. It's not always the case. About 75-80% of the time they do. If we have high put walls, it's very common for us to see, especially as we get closer to that monthly OPEX, where we get above that put wall. And again, that's about 80% of the time. 20% of the time, it doesn't work. One example of when it didn't work was December 2018. It just cut right through it like butter. And then it wasn't until, I believe it was Christmas Eve on the 18th, that's when things started turning around. And that was already after the December monthly options expiration. So it does happen, but we shall see if the VIX falls and cooperates with that. If not, it's okay. We have a plan for that as well too. Okay, so let's just go to the charts here for a second. Let's go to ES. I still think that if we do have a rally. And again, repeat from last time, big picture, we are in a downtrend. This is just a bear market rally, okay? The major trend is down, big picture is down. The easy trade, again, is to be patient and buy put spreads that are 3 to 6 months out at this level or a little bit higher, okay? Around here. That is the easy trade. Be patient and buy put spread 6 months out right here. Now, if you want to do some other trading, just be warned, it is going to be difficult. We are in a bear market rally. However, I suspect that if we close under this level right here, we may see some fresh hedging happening if we close under this. And the reason why is because there was on the way up, there's been a lot of buyers and accumulators on every touch at the lows. So those are freshly bought shares on SPY around this level right here. So I can definitely see that if we close under that, though the people that bought shares right here may want to then sell calls at around strikes that are here and buy protective puts. All right. And so from our previous discussions from last week, if we have a lot of institutions that are selling calls, the market maker has to buy those calls, which is a long position. So they need to offset that with a short position. So they will be shorting the underlying. Same thing with buying a put. If institutions buy lots of puts, the market maker will have to sell them those puts, which is, again, a long position. So to even out their books, they will have to short the underlying. So selling calls and buying puts is a bearish position for for the market participant, but for the market maker who's taking the opposite side, it is a bullish bet for them. So again, to offset, they need a bearish position. So if we see a lot of institutions who bought shares here, if we see them selling calls and buying puts at the same time, doing a caller trade, definitely then we can see the market maker having to short a lot of inventory in order to even out their books. Most likely the VIX is going to pop because of all the puts that are going to be in demand. And I'm sure that all the buyers that bought around here, they will scramble to hedge as well too, if we lose that level. Again, it's not a prediction. I'm just anticipating for that possibility. Okay. Conversely, if we close, I think, above these levels right here, I think there's a lot of, I think there's some covered calls and also in the money puts that will have to get closed. So if institutions are scrambling to buy their calls back and sell off their puts, the market maker will have to take on that short position. Therefore, they will have to long the underlying, and therefore we may see prices going up. I think somebody just joined us. Please place yourself on mute if you're in the audience. We can hear a little bit of background noise. But anyway, so that is a little bit of the delta hedging phenomena that we're going to notice. And that effect gets stronger and stronger as we get closer to monthly OPEX. So we are now what? About a week away. So that effect is going to be stronger. Let's see what happens. I suspect that a lot of people are hedged for tomorrow's report. Let's see if some of those hedges come off. If not, again, we may see people scrambling to hedge even more, and the markets may go down. If those hedges come off, then most likely we're going to drift higher. Okay, and again, the easy trade is to stay patient and buy 3 to 6 month put spreads on indexes here and here. Okay, maybe even possibly UVXY call spreads, just because the VVIX, well, at least the last time I checked, was still low. VVIX is the VIX of the VIX. So, the VIX tells us how expensive call and put options are for SPX and for SPY. The VVIX, which is the VIX of the VIX, tells us how expensive calls and puts are for VIX and UVXY and any type of VIX futures ETF. So, I mean, we're still at a low. Yeah, it has come up. But we are still at historic lows. All right. I told everybody on Discord that on the equity indices channel that I bought some December call spreads on UVXY here. And actually, let me show you which ones I bought so that you can see for yourself and there's no question about it. See, I have positions right here. I bought the 15 and sold the 20. Not a lot. The reason why is the OIs are so low, and this is more of an experimental hedge for me. Again, in order for me to effectively hedge my portfolio and my SPY shares, I'm gonna need like 300 to 500 of these spreads, and I don't know if the December options chain has that type of depth for me to hedge fully with UVXY. But I think about 20% of my hedging, I may try and use UVXY. Maybe not 20, maybe like 10 to 20%. So I'll try to buy 10 to 20 of these a week. I've already met my quota for this week. I think I can buy 5 more, and then I've met my quota. So I'm going to be buying about 10 of these a week until it becomes unfavorable to do so. Either UVXY goes up or VVIX goes up and becomes unfavorable to do that. But either way, I'm going to keep doing this if the markets keep drifting up higher. Okay. And but most of my hedging, I'm going to be using index options on index ETFs. Right now, I'm leaning toward the triple Q and the IWM just because they are the most credit sensitive. So I think the next move downward in the equity markets is going to be, it's going to coincide with a spike in the 10-year. And so I am leaning towards those indexes to build put walls. But we'll see as we get closer and closer to that time. I'll take a look and see which index gives me the most favorable edge. But with this, I built these hedges around this level, and I'm already at a slight profit in these. I think I'm up about 10-15%, and most of that has to deal with just the skew. I just was able to enter while the skew was very favorable. Actually, it was around this. It was 149, and it was a little bit higher here. It was like 155 or so. So that skew definitely was more in my favor then, and so that's why right now I'm at a slight profit, even though it really hasn't moved much from where I bought it. But we'll see how that goes. So that's one way to hedge. Okay. One thing that a lot of people noticed, especially recently, was China. China's market, well, not today, but in the last few sessions, it has really gone up. Okay. Now the question is this really a rally, or is this some short covering? All right. I think the lie detector test for China is the Australian dollar. Okay, whenever China recovers, oh, well, look at that today. Look at that. So yeah, whenever economic activity is about to increase in China, usually there's a bid for the Australian dollar because China gets most of their minerals and their metals from Australia. So they need to buy US dollars in order to conduct trade with them. This is usually a lie detector test. Usually if we see a breakout in AUD USD at the same time as a breakout in FXI, that means that move is more sustainable. All right. That means that, the lie detector test is saying, no, this movement, it's the truth. All right. Look at this. It's breaking down. All right. I think definitely if we break this level right here, definitely then this is not a real move. It's a fake. It's probably just like short covering or something. So we can expect that to go lower. All right. China also has a lot of their GDP is also dependent on real estate, and a lot of their real estate companies are burdened with a lot of debt. And in this environment with rising interest rates, any company with a lot of debt is going to get sold off. So definitely understandable. Also, too, a lot of Chinese companies are high-value tech companies. Again, when inflation goes up and interest rates go up, all that future growth that's priced in becomes less valuable. All right, people want current earnings when interest rates are going up because of the way current earnings are valued when interest rates are higher. When interest rates are higher, future growth just doesn't mean as much. All right, people would rather have current earnings today. Okay, so it looks like we will see soon whether this is just some short covering or a real move. I'm leaning toward that this was just short covering. I think this is, if this breaks down here, definitely that is our signal. Let's look at what metals are doing. Actually, let's see what copper is doing. Copper usually is a good indicator. Yeah, see, so it's going back to where it broke out right here. If we lose that, definitely, that means, yeah, that means as a lie detector, that means that move is not going to sustain itself in Chinese stocks. Let's look at some other metals. What's going on in gold? Gold sitting there looking pretty. Silver, very good. I know a lot of you are trading grains. Corn breaking out. Breaking out. Well, not yet. Not yet. It's still in a range. It's still in a range. We will see if that range continues or not, or if it actually starts breaking out. Let's look at wheat. I know wheat's been on the news recently. What is it? I saw a news article that where one of the ministers of Russia, Lavrov, he was in Turkey, and he was asked by a reporter whether or not Russia is stealing wheat from Ukraine and selling it themselves. Does that really affect wheat prices? It's hard to say. But another report that came out right after that was the WHO said that there may be some food shortages coming up in 2023. That it's very likely. In that case, we can expect prices to go up. Let's look at soy. Soy is the strongest of the food commodities right now when it comes to the grains. I think this is also affecting meat prices too. Yep. Oh, look at that. Feeder cattle still on a rampage. All right. Still going. Let's look at hog prices. Hog prices are coming a little bit down. All right, but still within its range. Let's look at some of the stocks that are affected by food. Tyson. Hormel Foods. McDonald's. McDonald's is actually one of those companies that remains well hedged for food prices. I mean, there's a reason why that they're able to keep those chicken nugget prices pretty consistent. Actually, most people don't know this, but McDonald's was one of the pioneers in futures commodity futures hedging. All right, they were able to figure out that the price of chicken is just a combination of the price of grains plus water plus energy. All right. So chicken prices is pretty much just a sum of its components. And so they're able to hedge that risk. They use a lot of grain, water, and energy futures in order to hedge that price of that meat. So that, that's why they're able to keep their prices pretty consistent over time. So it'll be interesting to see what their earnings say about their hedging activity. So no trades here regarding that. I think the easy trade is over when it comes to those grains for now, unless there's another opportunity that comes up. But any type of direct futures trading in grains, I think is going to be very difficult. It's hard to manage risk on something like on this. Even if you think it's too high, I mean, what if it keeps going high? What if it just breaks out, right? You could short it, but then, you could be facing a huge drawdown way up here, right? Same thing if you're long here, but then it just, it corrects a little bit. I mean, that's a huge drawdown for a leveraged contract. So there's really no way to really effectively manage risk making any trade here. So when we don't have an edge, it's better just to sit out. Okay. All right. Any questions on anything I went over so far? All right. Let's go over some current positions that I'm in. Today we had the ECB meeting, pretty much in line with expectations. They didn't really change anything. All the interest rates remained the same. They've broadcasted that, they've already signaled that that was going to be the case for this month, next month, and August. So, hope maybe in September we see rate hikes or we see some tightening. We shall see. We don't know. Okay. And it looks like after that, Euro has been selling off. I still have those Euro calls. They're a little bit under the water right now. I think they're about 15% underwater as we speak. Not really disappointed in that. I mean, it happens. There was a setup. I bought at a value point, and I was able to use an instrument that manages risk. And not every setup that you do is going to work out. It is what it is. So this one I'm not really that disappointed on. The setup was there. I did the right things. I waited for that. I was patient, and I entered the right trade. But it's just not working in my favor. And that's okay. I am going to say that I'm going to be proven wrong if we close right under here. If we close for the day under this level right here, that 1063, 1062, I'm going to cut my losses on those calls and just move on. As long as it remains in this range, I'll hold. I have until November. And it's a small position too. So we'll see. We'll see. I'm also still in my XLF lotto long. Not really happy with this trade. Did not work in my favor. Yesterday on the video, I said that if we don't close green, I was going to get out. Well, I didn't do that. I broke my rules, and I just held. I mean, it is a small position. Again, like I said in the other video, it's about 15% of my last UVXY win. The last one I did was the 12 puts for June OPEX. I bought at 23, got out at 38. So yeah, I used about 15% of that, and I bought some cheap calls for June 30th with that. So if it goes to zero, it is what it is. But, looking back, I probably shouldn't have even entered that trade. I got a little too eager. I let the ego get to my head a little bit. And that's one thing I want to talk about today. One thing I want to focus on is trader psychology. All right. So I have a friend who's in the Delta, was ex-Delta forces for the U.S. military. And he did a lot of sensitive missions. He told me that after every successful mission, every person involved would be required to take a 6 to 8 week leave. And the reason for that was because after every major victory like that, sometimes it gets to your head. It gets to your head that every mission you do is going to be a success. And people are humans. Even, Delta Force, special forces in the military, all these guys are human beings too. They make mistakes. So definitely, when you're off of that high from that victory, sometimes you can overlook things. It is human nature. All right. If you look through, I know this is a new Discord group, so you can look through my personal Twitter and you can see all the trades that I did. Last month was a good month for me. We had some futures trades at May OPEX. I was able to make like $5,000 to $7,000 per contract on some of these NASDAQ futures contracts I had. And so, and all these UVXY wins. And so I was coming off a string of victories, and I think it got to my head. Definitely got to my head. I just saw a few components get some buying, like, JP Morgan, Morgan Stanley, Goldman Sachs, Citibank. They saw some buying. I just saw a couple of those components see some institutional buying, and I went long on some options. And I didn't even wait for a value level or like a critical point to enter. I just entered right then and there impatiently. And definitely, I think it's from there. It's the Midas touch curse, right? You think everything you touch will turn to gold, but it's not the case. Now, I know that is my tendency. I'm kind of skittish like that. I'm also very trigger happy. I know this. So internally, I have my own risk management to limit my risk. Usually what I do is after every major trade that I do, all the trades that come after that are just a percentage of the last trade's winnings. So after a major trade, all my trades that happen gets smaller and smaller and smaller. And what do I mean by a major trade? So my last major trade was those put walls that I built on the triple Q back in March and April. So back in March and April, I bought these 3 to 6 month put spreads on the triple Q for about anywhere between $1 to $1.25. They were $5 wide. I was able to sell them for anywhere between $2.50 to $3. So, you know, a little bit more than doubled my money with those. And that's a trade that I definitely leaned on. Okay. My next major trade, again, like I said, is going to be buying those 3 to 6 month put spreads on IWM or triple Q 6 months out at higher levels. That's going to be my next major trade. But the one that I did before was that March and April put walls that I built that I cashed out at the end of April. So after that, all my trades have been getting smaller and smaller and smaller. I only use a percentage of the last win as the amount that I go into any new trade after a major one. Okay, so I purposely do that because I know that after wins, I start getting very trigger happy and I start getting into all these trades that I normally would not have. I normally do not trade XLF, but I thought I was being clever by buying options that are lower IV, but it turns out it's not so clever after all. But again, internally, I know this. You know your psychology better than anyone else. That's just one technique I use to really make sure that I don't blow up my account. Or, more primarily is to protect my profits. After all this trading, I want to, go home with something, right? And so that's one methodology that I've used. Is to get smaller and smaller and smaller and then wait for that major trade that you can lean on that has a higher probability, and that's the bigger trade that you do. Okay. So I just wanted to share that kind of that psychology. I know a lot of people take a break after a string of losses, but I think it's also important that you take a break after a string of wins. Okay. And again, a lot of special forces divisions in major militaries, they do this. And I think it makes a lot of sense to do that. So, just some food for thought. Okay. Today, I also said that I was going to talk about what institutions look for in dividend stocks. I know a lot of you come from the same Discord that Toasty and I were part of before this, and back in November or December or so, both of us were sounding the alarms. Hey, the market conditions going forward are going to be different. We're going to be in a high inflation, rising interest rate level. At that time, I told everybody, hey, growth stocks are going to be in a world of hurt. I said that, a bird in hand is worth more than two in the bush, meaning, current earnings. It's all about current earnings and current dividends. That's what institutions are going to be looking for. Growth is just not going to be as desirable as a good dividend paying stock with good earnings. Okay. And I think a lot of you heard that message and then started looking for the biggest dividend you can find. Okay, that is not how institutions look for dividend-paying stocks or looking for yield. All right, that's just not how they do it. All right, one example that one of our members brought up was Simon Property Group. Okay, they mentioned that there was a $1.65, $1.70 dividend. They were so happy about this. What is this? A $6 dividend on a $106 stock, a 5 or 6% dividend yield. They were so happy about this. But look at the chart. It's going down. Well, why is that? Why is it that it's going down? Well, because even though the dividend is high, this company has a huge debt. Okay. If you go to, something like, I don't know what you guys use. You can use FinViz. You can use, SEC.gov. But I know, looking at the SEC.gov PDFs, some of you are going to get bored out of your minds. But if you look at, let me go to FinViz real quick. If you go to FinViz for the Simon Property Group, you see, look at this debt. Look at how much debt they have. All right. At the same time, they're still paying this $6 dividend, which is about half of their earnings per share. All right. And you'd think, actually, their earnings per share on a trailing 12-month basis is actually 6.78. And their dividend is 680. So, I mean, so do you think that dividend is secure? Probably not. They're probably going to have to cut that dividend, or something's got to give, right? I think the market is expecting that. So that is definitely not, just because they have a high dividend doesn't mean that that's a company that is desirable to institutions, okay? I've been saying this, I've been pounding my fists about this. Dow Chemicals. Now that is an example of a company that institutions are definitely looking for and accumulating. I see a lot of accumulation happening in this zone right here. As a patient trader, you should wait for 63, 62, okay? If you want to be a little bit aggressive, you can start accumulating here. But I'm going to wait. I'm going to wait for that nice value area, okay? If we get there. Hopefully we get there. If not, we'll see. I mean, it can definitely correct to this line right here, to 64 or so. Or it can correct through time, which means it may just go sideways until we hit that. Either one. Once it hits this line, I'm getting in. All right, I'm going to get in. And, if you look at Dow, okay, actually, I think on Analyze, yep. So let me go to fundamentals, Dow, okay. So look at this, earnings per share and dividends. So its dividend is $2.80. It's 70 cents a quarter. Its dividend yield is 4.4%, higher than the 10-year. Okay, so one of the things that if your company doesn't have a growth component to it, and and institutions are judging you just by your free cash flow, your current earnings, and your dividend, and right now I believe the 10-year, what's a 10-year at right now? At around 3%. So why should any institution that really cares about yield, and I would say most wealthy people, they care less about the capital appreciation of their securities. What they really care about is yield. All right, why should an institutional investor take on equity risk if they can buy a 10-year treasury and get 3% without having to risk having to take any type of corporate risk, right? So if you don't have a growth component and your dividend is like 2%, what makes buying your stock more favorable than just buying a 10-year treasury and getting 3%? Okay, so that is kind of the dividend pricing correction that I see is about to happen. Actually, one of the stocks that is a great example is this company, Hormel Foods. There is no growth component to this. Okay, they make Spam and Vienna sausages. All right, I don't think Spam and Vienna sausages are on the up and up in growth. All right, this stock is definitely being judged on current earnings and dividends. All right. If you look at their dividend yield, it's 1.9%. 1.9%. All right. So why should I buy your stock, risk capital depreciation, when I can just buy a treasury and get 50% more yield, right? And take on way less risk. So this stock, I can definitely see it correcting until the dividend yield gets to where the 10-year treasury is. All right. And so right now, let's take a look at what was the dividend again? The actual dividend amount per share is $1 or $2. So let's say our 10-year treasury gets a 3.5%. Let's just say Okay. That would mean if it goes to 3.5 and this really corrects, potentially this stock could go to 28.5 if we have a 10-year treasury rate of 3.5%. If I'm already forgetting numbers, what was it? 102. Okay. If we remain at a 3% 10-year, which I highly doubt, but I mean, let's say we're in that kind of world where it just stays at 3, then I can definitely see this correcting down to 34. At 34, that dollar dividend would be 3% yield. Okay. But I think we're going to go more to 3.5, 4, which means this could correct down to here at some point. It may take a while, but I can definitely see that in the realm of possibilities. One of the other things that institutions are looking at is the dividend payout ratio. Okay, the dividend payout ratio. What is a dividend payout ratio? There's two ways to calculate this. You take the dividends and you divide it by net income. That's one way. Or my way, which a lot of professionals use as well, as just an alternative, is you can do the dividends per share divided by the earnings per share. Okay, dividends per share divided by earnings per share. All right. Right now, HRL Hormel Foods has about a 58% dividend payout ratio. Okay. During these times when costs are going up, investors fear for that dividend. They want to make sure that dividend is secure. Okay. How would an institutional investor feel secure about a dividend? Definitely if your earnings per share is rising, your free cash flow is rising, as well as your dividend payout ratio be under 40%. So if your dividend payout ratio is under 40%, it means that your costs could go up, your earnings could come down, but your dividend could still remain secure. Okay? This one has a 58%. So the higher it is, that means the higher your dividend payout ratio is, that means more of your earnings are being used to pay for today's dividend, right? So if those earnings come down, well, that, you start risking that dividend. It may get cut or it might get thrown out completely, all right? One example of a company that has a very low dividend payout ratio is Mosaic. Mosaic is their fertilizer manufacturer. They're in the institutional world, Mosaic is considered the inflation stock. All right, the inflation. I mean, we were sounding the alarms on inflation when back in November, October of last year, and since then, this stock has just gone up a lot. All right, it's just having a little correction, that's all. But I mean, the stock has done tremendously. All right. But the dividend payout ratio, look at that dividend payout. Their earnings per share is at $7.07, and they're paying a 41-cent dividend per share. So what does that mean? That's a dividend payout ratio of 5.8%. So only 5.8% of their earnings per share they're paying out in dividends. Guess what? I think in the next two ER releases, they're going to raise that dividend. Look at that year over year. Look at their earnings per share is going up. I think they're going to raise this dividend. Their dividend is quite low compared to, the 10-year. And I think they're going to raise it. They're going to raise that dividend in the next two earnings. Mosaic. Let's look at another one of my favorite stocks for dividends, CVX. Look at this. Dividends per share is $5.52. And earnings per share, $10.63. That's about half, 52%. Okay? Yeah, I said, that 40% is nice. And I think, yeah, ideally you want 40%, but also look at their earnings growth. I bet you next quarter, they're going to grow their probably earnings are going to go up with all these higher oil prices and gasoline prices. So not only do they produce crude oil, they also refine. So they're making money on both sides of that business. So I can see their earnings going up. And Chevron is one of those companies that has a 35 plus year track record of raising their dividend. But guess what? Their dividend right now is still higher than that 10-year treasury rate. This is an amazing company, guys. Chevron is an amazing company. They're probably going to raise that dividend soon. That's an amazing company. But right now, any long that I do in any individual stock, I'm going to stick with this. This is really my next target, Dow Chemicals. Look at that. Look at that dividend payout ratio. 2.8 divided by 9.18. 30%. Oof, look at that. 30%. Only 30% of their earnings they're using for dividends. And guess what? Their dividend yield, 4.4%. Way more than a 10-year treasury. This is the company I want to be in. And not only that, the industry that Dow is in, it's in chemicals, materials. Also, it has a fertilizer business as well, because it's in chemicals. After all, it's a Dow chemical company. But this industry does very well in mid-stage inflation. And I think we've already entered. I think we're on the very beginnings of the mid stages of inflation. And usually in the mid stages of inflation, this is where we start seeing dividend stocks correcting. Okay, we start fearing for that dividend. Do we have enough? Is there enough earnings for that dividend? Is there a possibility that this company might cut their dividend because costs are going up too high? Okay, investors are going to start asking. They've already started asking those questions. Okay, so really, it's going to be companies like Dow, companies like Chevron that I think will continue to perform well going forward in the next stages of inflation. All right. I hope that helps. Now you may be thinking to yourself, well, what about a company like Apple? Apple, it's not doing the best, but out of a tech stock, it's holding up. It's holding up decently. It's got a dividend. Does that mean it's going to sell off until this dividend yield becomes the 10-year treasury? No, because Apple also has a growth component to it, right? There's a growth component. And so they're going to be priced not only on their dividend, but also on their potential growth going forward. So they're not going to have a dividend yield that matches the 10-year. Or if they do, that's going to be, that will be one of the biggest buying opportunities of Apple ever. I don't think that's going to happen. But again, it's because they have a growth component that performs very well. So for that, investors are willing to give up some dividend yield for that. Okay, but those kind of companies are very rare. All right, those kind of companies right now are very rare. They're still going to have some tough times ahead. Microsoft is one of them too. Great company, has a growth component to it. But right now, it's not the time for growth. Dividend is secure. Look at that, very low dividend payout ratio. So their dividend is secure. Apple's dividend also very secure. Very secure dividend. 89 cents out of $6. That's like what? 14%, 13, 14%. It's secure. Okay. But again, for any long swings, I'm limiting it to this. This is the company I'm going after. So we'll see. I'm going to be patient about it and try to get a good value area to enter. At that time, when I enter too, I may discuss some other strategies. I may enter with low delta leaps. Basically the thought around a low delta leap on a stock that I think is going to move a lot is that sometimes the Black-Scholes-Burton model, which is a model that it's a mathematical model that prices derivatives and options. I think that that the Black-Scholes-Burton model is known to not price tail end volatility very well, especially on calls that are longer dated, about a year or two out. It tends to misprice that volatility, all right? And so I might use that. If the conditions are favorable, I might use that as my means of getting long on Dow. And that strategy, I'll go into more detail as we get closer. It's a little bit more advanced strategy. You do have to know a little bit about your Delta Greek. So perhaps one day I will put that in a course so that our more advanced members can go through that. All right. So that's what I have for today. Any questions? I'll open it up to voice. Just remember, I am recording. So if you don't want your voice to be heard on the recording, you can always type your questions on the voice chat text. Oh, I see some of you have already. Oh yeah, I muted PP because he had all this background noise on there. I hope that's not the reason why he left. I was just gonna unmute him afterwards, but I just heard some background noise and I just muted whoever's light was blinking. So, PP, if you're listening to the recording, you know, it wasn't anything personal. It's just like I couldn't concentrate with all that background noise. You want to take a look at XOM? Yeah, it's about about half. Nice year-over-year earnings per share growth. Dividend yield 4.23%. Look at that. XOM. That's also a good one. Now, you know, again, this is just from my observations. I prefer Chevron over Exxon. I've got my own reasons why. I think Chevron is better positioned for growth for the next 5, 10, 15 years. They're more into renewables. Their geothermal energy division is already profitable. That's why I prefer Chevron over Exxon. But yeah, it's a similar principle. They have a very high dividend yield. They're probably going to raise their dividend. Exxon also has a history of maintaining and raising their dividend as well. So it's a good company to be in. I mean, right now it's run up a lot. So if you want to get in, I would wait for a pullback. But you know, and also too, I do feel that oil may come down later this year, around October or so. Actually, let's look at oil for a second here. Somebody mentioned that gasoline was up, but oil was down. I mean, still, that's one day. One day does not make or break a trend, okay? It's still very correlated. I mean, look at it's only down 49 cents. I mean, come on. That's nothing, okay? It's just noise, all right? As long as the main trend is up, as long as the economic conditions are such that refineries are still making fat margins on selling gasoline and buying oil, refining it and selling gasoline, as long as the economics is still there and margins are there, that crack spread is still wide, they're going to keep doing it, okay? And again, any trade right now is difficult, you know? How do you manage risk on this, right? How do you manage risk? You want to go long here? Well, what if it corrects? It can still maintain its upward trend and still come down here. You know, do you want to take a $16 loss on a futures contract? That's 16 grand per contract that you're losing. You know, do you want to take that kind of drawdown? There's no way to effectively manage risk if you go long here. If you short here, well, what if it just keeps going up, right? What if it blasts past 130? Definitely a possibility. So how do you manage that risk? There's really no easy way of managing risk at this point, entering either direction here. All right. Again, the easy trade is going to be to wait for gasoline supplies to hit a peak. Once gasoline supplies hit a peak and we see a breakdown in the price of gasoline, we're probably going to see a breakdown in the price of crude. And when that crude breaks down and then retests, then we short. That is the easy trade. Okay, now when will that happen? I have no idea. It may be next week, maybe a couple weeks from now. Most likely it's going to be around September, October. So we may have to be patient, but who knows? I'm looking at the gasoline inventories on a weekly basis. And if I see anything, I'll definitely let you guys know. But for now, I'm not seeing anything. So we wait. We wait until we have an edge. Okay? That is how we maintain discipline. That is how we maintain our mental capital. Okay? We can lose money. We can always make it back. But if you lose your mental capital, if you lose your courage to enter trades, if you lose your wit, sometimes you can't get it back. Okay? So preserving your mental capital, preserving your psychology is very important. Okay? And I don't think entering a trade in crude oil is good for your mental capital at this point. Again, how do you manage risk? You're just going to have sleepless nights. All right? Let's wait when we have an edge. Okay? Anyway, that's my spiel. Let me...
You almost did it.
Yo, PP, I unmuted you. Sorry, you had some background noise. We're still recording right now. Anybody who wants to ask questions, you can go ahead and unmute yourself and ask away. If you don't want your voice to be on the recording, you can go ahead and type it out in the voice chat text.
Yeah. It's like
Okay, so there's a lot of background noise from you, PP, so I've muted you again. It sounds like you're driving or something. So let me know whenever you're in a quiet place, and I'll unmute you. Any questions? I see people typing. Let's give it a minute here. Do you want me to unmute you? PP, you want me to unmute you? You have a question? I'm taking your silence as a no. ATOS. What do you want to look at ATOS for? For the dividend yield? I don't think they have a dividend. Oh, God. No, this is not the environment for this. This is not the environment. I mean, sure. I mean, it could go up, but I mean, what's your edge really? When to sell covered calls on this? Well, it also depends on when you bought in. I know a lot of you guys are in ATOS from years past. I don't know what your buy level is. Some of you all bought really low, years ago. Like, I don't know. Let's see here. Oof. I know some of you guys bought around here. So if that's the case, you could start. You could always sell covered calls now, as long as you're selling at strikes above your buy-in point. Now, if you bought, let's say, around these levels and you're down here, I mean, you can sell covered calls, but you're risking getting assigned. Because I don't know how much premium you're getting out there. Yeah, you're not even getting that much premium. I mean, if you are selling the Julys, you can only go. So if you bought it at 4, you still are taking a risk if you sell here because you could get assigned at a lower price than when you bought in at. How far do you need to go out to get some decent premium on 4s? I mean, that's tough. But this is not the environment for shit stocks. There's more pain ahead, most likely. Unless something out of the ordinary happens. I don't know, if they get a new drug approved, whatever, minus any huge news like that, which I don't follow this stock very much, but, depending on what happens, if there's some like crazy good news, and I can see it going up, but, minus that, there's a lot more pain ahead. It's not even making positive revenue. I mean, it probably has a lot of debt. And as those debt servicing costs go up, what do you think is going to happen to their cash flow? You know? Mitch, I see that you're on. You're not muted. Did you have a question? They did. They introduced a new ATOS. Introduced a new drug. Okay. Is that where this rally is coming from? Oh, by the way, earlier we took profits on our Neo call spreads. Very good call there, Ari. It was one of Ari's ER plays. She tends to be very good at handicapping these. She's not always right, but I would say more right than not. And she's usually right about the movement that happens afterwards. Even somebody who's like 55, 60% right on those, that's a huge edge. So I can respect that. You know, that's not my style of trading, but I can definitely respect somebody who's good at that. So, you know, that's definitely a unique skill to have, is handicapping those ERs. So that was a good trade. That was a good trade. My spread ended up making 138%. I showed you all how to build that spread yesterday. Basically, I bought a lower IV put, it sold a higher IV put, and then when that IV crushed and at the same time I got the price movement I wanted, I mean, that was like a double positive for my puts. All right, so not only did I make money off of the IV crush, I also made money off of the movement down. So that's putting the edge in your favor. So not only do I have an edge with this person who's very good at handicapping, I also put an edge with my spread. So a mathematical edge with the way I structured that trade. Okay, you always want to stack the odds in your favor. Okay, that's just one example. We'll go through a lot of trades in the future in these videos. Oh, I see this news. Well, okay, we'll see. We'll see if they make money off of this. If they can make money off of this, I'm sure this will keep going up. But if for some reason, if it's just a milestone or something like that, it's going to come back down. All right. So, you know, investors are looking for current earnings right now. They're looking for current earnings. They're looking for yield. All right. That's what institutions are looking for. They're not looking for this. Okay. They're not looking for home runs. You know, most wealthy investors and, you know, most wealthy people don't really care too much about capital appreciation. What they really care about is yield. It's really all about yield. All right. So I don't know how much participation, how much more you're going to get out of this, but if you're long, I hope this goes up for you. But I will not be I think I bought like maybe 1,000 shares in one of my accounts when it was like in the $1 to $2 range, like a few months ago. But you know, that's like nothing. That's like a lotto for me. You know, that's like the size of one of my really small lottos. So I could care less. You know, I could go to zero and just it's like a week's worth of premium selling for me. So it doesn't really matter to me that much. Okay. Any other questions?
Hey, Mickey, it's Nunya. Not a question, but you guys are, you know, if you haven't already, and I understand it's time consuming, it's give or take an hour, but you guys really need to check out that YouTube video on earnings.
Hopefully,
earning, you know, it's not really hot right this second because you know, not a whole lot's coming out, but when the FANG stocks and stuff like that are going through earnings, I mean, it's killer. Absolute.
I'll go ahead and, you know, one of these days I'm going to back test all those strategies. I'm going to go through and collect data and back test everything that video says, and I'll post my results after I do that. The high noon highlights are for, you know, this day's trade, going over trades, going over concepts, and things like that. But I'll post a separate video that's apart from the high noon highlights. I'll go ahead and back test all those trades, and I'll tell you what my findings are. I think Toasty said too that he's going to try and to look at that and do a back test of his own. So definitely we'll let you guys
guys,
know.
I was just giving
what.
it was just small reminder.
Okay. Yeah, that's cool. Any other questions, concerns, other trades you want to see? Okay, well, in that case, I'm going to stop the recording. Stay safe, guys. All right. We do have FOMC coming up on Wednesday. We have CPI numbers coming out tomorrow. If you're going to trade small. All right. Limit your risk. Again, the easy trade is to wait for higher levels, buy put spreads 3 to 6 months out for the continuation of this longer term trend. That's the more high probability trade. That's the easy trade. Everything before is going to be difficult. You're going to get chop. There's going to be a lot of chop. So again, keep those positions small, or better yet, just be patient. Don't do anything until we get to those higher levels. If we get there, okay? Again, not trying to predict the future, just anticipating what could be. If we break this, then perhaps we buy some shorter dated put spreads and we write it down, okay? But if we break to the upside, maybe you can lotto some longs, all right? Keep those positions small. Again, the big trade is going to be to wait just in case if the market rallies a little bit higher. The big trade and the high probability trade will be to short right here via put spreads, defined risk, all right? Big picture. Okay. Well, have a wonderful day. And next week, we'll keep the same schedule. Tuesday, Wednesday, Thursday, noon Eastern time. We'll have our high noon highlights then. Have a wonderful day, guys.